You may have heard things online. Don't claim too many deductions. Don't deduct your home office. Don't show too many expenses because those things will trigger an IRS audit. But that's not how I want you thinking about this. There isn't a magic list of 7 things that automatically gets your business audited. What matters is whether what's reported on your tax return is accurate, properly reported, and supported by your records. So today, let's look at 7 tax red flags home care agency owners should pay attention to. Not because they automatically trigger an audit, but because these are tax compliance problems you don't want sitting inside your business. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, and IRS rules. And this is the second video in our series about protecting your home care agency from costly tax mistakes. Let's get into number 1. Income that doesn't reconcile. A home care agency can receive payments from several sources: private pay clients, government programs, insurance arrangements, the VA, or other third-party payers. Some payments may also be reported to the IRS on information returns. But here's what matters. Before filing, you want those numbers reconciled. What do your books show? What was reported to the IRS? And what appears on your return? Those numbers won't necessarily always be identical, but if they're different, you should know why. And remember, your income isn't determined simply by adding up the 1099s you receive. You're generally required to report your business income even when you don't receive a Form 1099 for it. Your records should show the amounts and sources of your gross receipts. So the concern isn't simply different numbers. It's not knowing why they're different. Red flag number 2. Misclassifying caregivers. We talked about this in the previous video, so I'll keep this one short. Giving a caregiver a 1099 doesn't automatically make that caregiver an independent contractor. The IRS looks at the actual working relationship. So the question isn't, do I want to pay this caregiver as a W-2 or 1099? The question is, based on the actual relationship, how should this caregiver be classified? If an employee is improperly treated as an independent contractor, employment tax consequences can follow. Worker classification isn't simply a paperwork decision, it's a tax compliance decision. Red flag number 3. Falling behind on payroll taxes. For a home care agency with employees, this is a big one. Imagine cash flow gets tight. You have payroll, rent, insurance, and other bills coming due, and you're waiting for a large payment to come in. It can be tempting to use money that should be going toward payroll taxes and think, I'll catch up later. Be very careful. Federal income tax and the employee portion of Social Security and Medicare with help from employees are trust fund taxes. The business is holding that money for the government. And under certain circumstances, failure to pay those taxes can result in the trust fund recovery penalty. That penalty can potentially be assessed personally against responsible individuals. We'll go much deeper into that in our payroll tax video. For now, remember this: payroll taxes are not business financing. Red flag number 4. Deductions you can't support. Notice I didn't say large deductions. If your home care agency legitimately spends $25,000 on marketing, the fact that $25,000 sounds large doesn't automatically make it improper. The question is, did you actually incur the business expense? And can you support it? Think receipts, invoices, and proof of payment. Your records should support the income and expenses reported on your tax return. So don't ask, is this deduction too big? Ask, is it legitimate? And can I support it? Red flag number 5, personal expenses becoming business deductions. Let's say you buy groceries for your family using the home care agency's debit card. Using the business card doesn't magically make those groceries tax deductible. And here's the important distinction. The mistake isn't simply using the wrong card. The tax problem happens when their personal expense ends up being deducted as a business expense. That's why separating personal and business transactions matters. It makes it much easier to identify what actually belongs to the business before those numbers reach the tax return. Red flag number 6, your books and tax return don't connect. Remember what we talked about in the previous video? A number on your tax return has a story behind it. Suppose your books show $600,000 of revenue, but your tax return reports $500,000. That doesn't automatically mean the return is wrong. There may be legitimate reasons for differences between your books and tax return, but someone should be able to explain the difference. Your tax return shouldn't feel completely disconnected from the financial records of your business. So the red flag isn't my books and tax return aren't identical. It's nobody can explain why they're different. Red flag number 7, guessing because your books aren't ready. Tax season arrives, your books aren't finished, accounts haven't been reconciled, income hasn't been completely accounted for. And someone says, just give me your best estimate. That's a problem. I'm not talking about situations where tax law permits a reasonable estimate or another accepted method. I'm talking about guessing because your financial records were never completed. Maybe you think you spent around $150,000. Maybe you think the agency made approximately $400,000. That's very different from having records that support the numbers being reported. So if your books aren't ready, sometimes the answer isn't to guess. The answer is to finish the accounting first. Then prepare the tax return using numbers you can actually explain and support. If you noticed, these 7 problems really come down to a few things. Report your income correctly. Handle payroll correctly. Separate business from personal. Keep good records and make sure the numbers on your return can be explained, because most tax problems don't begin at tax time. They begin during the year. That's why good tax compliance isn't simply about what happens at tax time. It's also about how you're running your home care agency throughout the year. And just like we talked about in the previous video, I don't want you running your business afraid of an IRS audit. I want you running it prepared. And if you're a home care agency owner and you need help with your business taxes or accounting, you'll find my information in the description below. Make sure you subscribe, because we're going to continue breaking down the tax and IRS issues home care agency owners need to understand. I'll see you in the next video.